Good morning. You're watching Metropole Television. My name is Simbalaja Charles Kiege. This is most certainly business. This or at this time of the year, we're looking back at 2020, what has been essentially happening in different sectors and industries of the economy. And this morning, we want to go back and talk about what has been quite a rocky year for the banking industry. I mean, everybody will say reduced profitability and mass provisioning for non-performing loans was exactly what was witnessed in the entire of 2020. All right. Let's therefore iterate. Kenya's banking industry has witnessed what has been a tough operating environment worsened by the coronavirus pandemic, which saw the number of borrowers defaulting on loan repayments hitting a new decade high. Data by the Central Bank of Kenya shows that the default rate grew to 13.6% in August 2020 compared to 13.1% in June 2020, marking this the highest default rate as one of the highest years since 2007, when the default rate was 14.1%. Even as the industry found itself in the tough environment, there has been an emerging conversation as to whether the industry is overregulated owing to the Central Bank of Kenya's tough stance on access to affordable credit and the effect of the repeal of the cap on interest rates yet to be felt, with 2020 closing with the lending rates again at historic lows. Now, most banks reported reduced profitability due to mass provisioning for bad loans taking the biggest share of the bank's expenditure, with CBK data now indicating that non-performing loans jumped to a high, now wait for it, 394.4 billion shillings as of August 2020, up from 349.9 billion at the end of February, the sharpest 6-month increase in recent history. This coming from workers and businesses who defaulted on loans worth, now wait for it again, 45 billion shillings in 6 months to August, when Kenya imposed stringent measures to contain the spread of the coronavirus pandemic. Now, the NPL growth emerged in a period when Kenyans deferred payments of 38% of the bank's total loans, or 1.12 trillion, a pointer that defaults, which is the credit that remains unpaid for more than 90 days and could have been worse without the credit rescheduling. That is how bad things have been for that industry in 2020. Now, let me give you some just bit of data that we have for you this morning that are pretty much going to show what exactly we've introduced there. Let's look at selective performance ratio of most banks, and as you can see on that data, you're going to say that yes, they were affected to some level as well. Let's look at the performance of a deposit, loans and advances, which also is going to show you that despite them increasing, there's that bit of how badly they were affected again by the coronavirus pandemic as well. Let's look at the loan performance as well in the entire of 2020, which is also going to show you that despite the number of loans to customers and businesses increasing, the performance was also heavily affected by the coronavirus pandemic. And we're going to actually show you this data as we go on in this discussion this morning. All right, to help us therefore close any discussion that we may have for the banking industry this morning, we are joined by Gabriel Mwendwa, investment associate, Horizon Africa Capital. We're also joined by Arnold Ngasale, senior relationship manager at Rafiki Bank. Gentlemen, good morning and thank you very much for joining us this morning. Let me begin with you, Gabriel. We've been with you for some part of 2020 and thank you very much for that. Let's clear that. For you, what would you say has been the outlook of the banking industry in 2020 as regards the effect of the coronavirus pandemic?
Very much, having again as a sector. I think one thing that we need to take note of is with respect to the percentage change in the non-performing loans, as you've mentioned,
yes,
about 45 billion.
Yes.
But if you put it in the larger picture, whereby we had 1.3 trillion worth of loans restructured.
Yes.
And the banks are only saying 45 billion is what they can classify as non-performing, which means we have over 1.2 trillion, which is okay. It tells me two things. One, the effect might not be as terrible as we thought it would be.
Yes.
Or two, to really come.
Yes.
That's the problem. Because you see, if you restructured 1.3 trillion of loans, and probably you give them 6 months, it means some of these loans are going to, the restructuring period is going to end in, say, February.
Yes.
So after February is when now you say, you ask the client, pay me back. And then the client now says, I'm actually unable to pay. So then you have additional NPLs at that point in time.
Yes.
So we're yet to really see the true effect. It's coming out clearly. We've seen banks like I&M issue profit warnings. We're expecting KCB to issue a profit warning.
Yes.
Because of the increase in provisions. But I feel because of that difference, the 45 billion versus the 1.3 trillion, we still have a lag. We still have some information we're yet to see on what is going to come.
Yes, Gabriel, if I may cut in on that point, there's some analysts who are saying, well, wow, why not just classify them as bad loans? Because essentially, if that restructured loan is at 1.1T, then what stops you from saying, well, they are not performing? Because there's some guys who are saying you should include them into that because, well, it's as a result of the pandemic and the effects of the pandemic are not yet out. So why don't you say, well, we have this ratio of bad loans that we don't know whether to classify as bad or good as well?
Well, I'll give you two reasons why you should not do that.
Yes.
One is because if you do that, then the market goes to the dogs. Because 1.3 trillion is 50% of the balance sheet. I mean, you've literally closed all those banks.
Yes.
That's one.
Yes.
Two, CBK has actually allowed it. Yeah, because CBK is the one who monitors and gives the regulation around declaring of NPLs, classification, etc. So the regulator has allowed it. So that's number two. Number three, these loans are actually not non-performing. I mean, personally, maybe I had a loan, and I'm saying, let me not pay the loan this time. Let me, buy myself a new car. Let me travel a bit. Then the loan will come when it will come.
Is that the assumption? Is that the assumption maybe we might carry?
It's the reality, but it's the reality. There are quite a number of businesses and people who actually decided to, to just park the loans because they can,
because
they needed to. So we have to wait for that effect to come up, because what you see is that 36 or rather 300 billion of the restructured loans is actually to personal. It's personal loans. So these are loans to individuals. They're not loans to businesses.
Yes.
So I mean, you can imagine the character of human beings. I mean, we have problems. There's the moral risk in insurance. So I'm also ascribing the moral risk to these loans that people who did not need it went rich. So assuming half of the 300 billion, that's already 150 billion. I believe businesses did suffer. So some of them just decided, let's stop our loan so that we don't get hit more. But I believe they will be able, some of them will be able to come back. But like I've said, that difference is too huge. 45 billion to 1.3 trillion, it's too huge.
That's a big difference.
Exactly, yeah. So assuming you take the current NPL rate of 13%, we're talking about 150 billion of loans that should have gone to NPLs. So if we currently have 45, it means we still have a lot we've not yet seen that is going to happen. But luckily, banks have been given some leeway by the regulator to work with customers. So you go discuss with their customers. So for example, something they could do is you issue a new loan to take care of the old one. So you see that goes away. Things like that. Banks can be very, very creative. But as far as their profits go, they're going to take a hit, but they have enough capital, or rather the big banks are actually very okay. Because I mean, if you're talking about KCB with 15 billion in profits, equity KCB with over 20, 25, 30, they're okay. I mean, even if they were to lose 5 billion of profits, they still are very profitable. Their shareholders do hurt, but the bank itself, the share capital is not hit.
Let me cross over to Arnold Nkusale, Senior Relationship Manager, Rafiki Bank, who's with us here in the studio. I saw you laugh and say, wow, that's a bigger difference. For you, what will be the outlook for the banking industry 2020 as regards the effect of the coronavirus pandemic?
Well, probably just to echo what Gabriel has mentioned,
Yes.
it's not as bad as we had anticipated, actually.
Yes.
I think when the coronavirus hit the country, there were knee-jerk reactions from a lot of industries,
Yes.
and the banking industry included.
Yes.
And I remember there was a lot of rescheduling of facilities, and initially most financial institutions just rescheduled for 3 months, and then there was a realization that this could actually take longer.
Yes.
But what we've seen a lot of innovation and creativity as far as financial reporting is concerned. And if you look at 2020, I think most people had anticipated that with 2020 there was a repeal of the interest rate capping.
Yes.
So there was an assumption that, okay, we're going back to making money, But of course, when coronavirus hit, we had to really repackage our business strategies as bankers. And that essentially led to us now working more with the customers, rescheduling with their facilities and so on and so forth. And what we realized is that during this particular pandemic, there are actually industries which performed really well and there are industries which are very affected.
Yes.
So it's just a matter of packaging your reporting and at the same time customizing the solutions that you're giving to your customers.
Yes.
So if you look at 2020, it's not it hasn't been as bad as we would have
And also,
anticipated.
are we saying it hasn't been as bad as we would have anticipated because we're yet to see the complete picture? Or we're saying, well, going by what is going on currently?
Going by what is going on currently,
Yes.
I would say the banking industry has demonstrated a bit of robustness
Yes.
in absorbing some of the anticipated shocks.
Yes.
And the banking industry normally performs with regards to the economy.
Yes.
So the economy has taken a hit. The GDP increase has been less than 2%
Yes.
for 2020 as compared to levels of 5-6% in the previous years.
Yes.
But at the same time, if you look at the banking industry, because of the innovation that has come in, most banks have been in a position to find a cushion
Yes.
to cover their positions in this particular period.
Fantastic. All right, let's therefore, gentlemen, talk about what has it been so far for the regulator. Now, Gabriel, I've asked you this question, and I'm going to ask you this question for the last time again in 2020. And I'm going to be very blunt to you this morning. Njoroge has been blamed for taking a customer approach. In fact, some bank bosses were complaining that they've never felt the impact of the cap on interest rates that was expunged. In fact, one of the members who's part of that Bankers Association chairman, Daso Igara, he said, forget expensive credit. Is he speaking as a result of what the regulator has told them? Or do they not have that flexibility to price their facilities? Now, to answer this in this respect, we are talking about the big boys already announcing profit warnings. KCB is going to do it for the first time in 18 years. Does that mean that come next year, therefore, they have a bargaining chip saying, look, Njoroge, you told us not to ask for expensive credit. We did not. We cushioned the economy from the effects of the COVID-19 pandemic. Yes, we did that, sir. Now it's time for you to pay back. Are we looking at expensive credit come 2021?
The question on CBK protecting the customer is, I think it's a very key thing for CBK to do because look at equity and KCB.
Yes.
Cost of credit is 2%.
Yes.
2%. That's how much it costs them to pay us or rather to keep our deposits, and that's what they lend. Remember, these banks do not have their own capital; they take deposits from you and I.
Yes.
So that's why CBK's protection of the customer is in two sides. There's the loans and then there's the deposits.
Yes.
So the fact that it is not paying fair price for the deposits, it's paying 2%. If they charge you 14%, they have 12% headroom. That's the CBK's thinking. That's one. Two
Yes.
is that, you see, with 14%, if you look at it, banks actually, it was proven in 2019,
Yes.
most of their money came from government bonds.
Yes.
So banks are not really keen on the consumer's interest. They don't want this interest. It could move from 14 to 18, but what would happen with it moving from 14 to 18? With rate, the
Yes.
T-bill rates. A bank like the Equity Bank has a balance sheet of 775 billion. but its loans are less than 400 billion.
Yes.
So where is the other 300 billion? They have over 250 billion in government paper, which is considered riskless.
Yes.
So if the interest rate on government paper was to increase by even 2%, they make way more money with way more less risk.
Yes.
With way less risk. Yeah. So
Yes.
it's really that the banks want the interest rate on loans to move so that the T-bill rates can follow. That's really the key, because, for example, if you're pricing a customer, if someone can't pay 14, what makes you think they can pay 18? And you also have to look at the broader economy, because 2 years ago, people were able to pay 18, now paying 14, or rather 5 years ago, we could pay 18, now paying 14 is looking like a struggle.
Yes.
So there is also the economic aspect of it. And what I want to say is that the regulator, of course, has their own rationale for trying to keep the interest rates where they are.
Yes.
And it's because of the economy, but banks are private businesses. Personally, I believe they should be allowed to price in risk for these customers.
Yes.
But the challenge, before you come to Simba, is that we are not weighing in the risk of the unbanked people, because everyone who borrows a loan from a bank, it does not mean they are the one who are using that loan. Some people borrow from banks to invest in their own private businesses or to lend to their own private ventures,
Yes.
which are the smaller businesses, a very small manufacturing entity that cannot be banked. Now, those ones are the ones that are actually suffering the most during this pandemic. So there's a layer in which CBK and the banks are not seeing. We have the borrowers from the bank, and then we have the actual businesses that use this money.
Yes.
So that layer is going to cause a problem. That's really where we are. But the pricing, as far as pricing goes, I believe banks should be given some leeway, because I think after some time they will realize they have to bring down that pricing themselves.
Pretty much. All right, Arnold, the same question as well.
Yeah.
Just like Gabriel is intimating, to probably be ready for expensive credit come 2021 because of the hit that these banks are taking now?
Yeah, because essentially, as a banker, before I lend you money, it's all about the risk profile of the client.
Yes.
And essentially, most financial institutions will peg an interest rate on the risk profile
Yes.
to cover their position just in case a default comes in.
Yes.
Now, when there was the capping, there was very little room to maneuver. But now, with the capping being repealed, the bankers will have more room to maneuver.
Yes.
But as Gabriel has intimated, most financial institutions are still leaning on a safer position
Sure.
by lending to the government.
Yes.
And recently, I just saw the CBK governor intimate that they had so many bids that they are now rolling over the short-term government instruments to long-term government instruments.
Yes.
So most of the people who are holding the T-bill papers are now being convinced to give more, to have more tenure on the paper.
Yes.
It's essentially bonds which are 3-7 year,
Yes.
which have a 3 and 7 year tenure. Now, concerning the aspect of credit, I think it's more of how will the market look like in 2021, for example, simply because 2021 you realize will be a year just before the election.
Yes.
And a year before the election, we normally have a lot of interesting economic activities.
Hopefully BBI will stop it.
Hopefully.
Yes.
But at the same time, if you look at it from that particular perspective,
Yes.
at the same time, you realize as a country we are a net importer. And that's why from time to time, the CBK will use certain instruments to cushion the economy. And the issue of interest rate controls and the CBK rate normally depends on the position of the economy. So
Yes.
it's going to be an interesting year, but at the same time, it's a year full of opportunity.
Yes.
Depending on the perspective that you take.
Depending on the perspective that you give it.
Yeah.
Now, here's the thing. We want to take a short break here on Business AM. But once we come back there for Gabriel, your question is going to be, if KCB, the biggest lender by asset base in the country, a company that is also thinking about going regional in terms of investments, is telling you, for the very first time in 18 years, we are going to issue a profit warning. Now, we do know what Njoroge wants. Njoroge has been tough of actually introducing new banks into the country. So if KCB, the likes of Cooperative, the likes of Equity are crying about reduced profitabilities, fine, they're well cushioned, they've got proper asset bases. What about the smaller banks that Njoroge really doesn't want to see in the economy? Are we bound to see more mergers and acquisitions come next year? And how are we looking forward to that once we come back here on a Business M year-end closure?